we've seen some high volume strategies and they don't work. It's such hand-to-hand combat.
Not with venture studio models. Yeah, I would guess.
It has to be concentrated. It has to be high quality. Otherwise, you end up like one of the biggest advantages in venture studios is the early ideation, testing, and discovery work, right? So these venture studios they tend to be wanting to kill as fast as possible, which you want. You should not be investing a ton of money and losing it. So usually we see this early like testing phase, 10 to 50,000, right? Or below, let's call it below 100. But you want to be able to write companies off, at least take the technical risk off the table as much as possible so that all you're dealing with is like execution risk and market risk, right? When we see high volume strategies, they're not taking that technical risk off the table because they're just trying to put a lot of stuff out there and see what sticks.
Hey everyone, welcome back to the Ignite podcast. Today, we're excited to have Sarah Adams Anderson with us. She's the founding partner of Vault Fund, a fund of funds, or a fund of something else. We'll talk about that. Redefining venture capital by investing in global company creation firms and venture studios. Interesting. She has 15 years of experience across roles in VC, investment banking, and fund management, including as the managing director at Centrifuge. She's helped shape the startup ecosystem with her really cool office there in Colorado, backing innovators behind the innovations. Welcome to the program.
Thanks, Brian. It's really nice to be here. Thanks for having me.
Well, I don't usually start off the pod like this, but for anybody watching on video, you can see the very interesting backdrop here. And I'd love to hear kind of some of the backstory of this amazing office you have.
So this is our library. We live in Colorado, and we actually moved to Colorado during the pandemic, so in 2021. And we had already started building this house, and we weren't expecting to all be working from home. So over the course of building the house, we didn't have an office. So luckily, we had a library, and I could just kind of set up a desk and set up shop in here. So it's quiet. It's perfect.
That's amazing. Yeah, we also moved out of Silicon Valley during COVID. And when I moved in here, this house was built in 2002, and it literally had the Pinewood IKEA from 2002 all over the house. And so the office behind me, the shelves were just this ugly Pinewood, and I had to like paint them right away.
It was like a cigar room, like one of those old cigar rooms that you used to have. Yeah.
It made my skin, because of the white balance on your camera, it made my skin really red. It was terrible.
Oh,
Now, yeah, like we painted it and I put some stuff up there, but not as nice as yours. I like the color. Although over here I have like kind of almost a similar blue. It's kind of a seafoam blue. Anyway.
Yeah. We credit for this. I'm not an interior designer, so these were like professionals that helped us out here.
Oh, very nice. Yeah, we did that for a couple of rooms in our house. First world problems. Walk us through how you got into finance, those early experiences you had at firms like RBC and JP Morgan, and how that shaped your perspective on what you do.
Yeah, interestingly, so I started my career in Washington, D.C. I was in the Senate right after college. I moved up, started answering phones, and I couldn't make a living. I literally worked 3 jobs. And I think I started out in the Senate making about $22,000 a year in Washington, D.C. I was basically living in a converted closet. Like, it was just terrible. My job, I loved my job, but I kind of felt like at that point, if I wanted to have a sustainable career, it was going to have to be in an area where, I knew I had a stronger skill set, where I knew I could make a strong earning potential. And so after about 3 years, I went back to business school and studied finance, knowing that no matter where you land in finance, you're going to be okay. And I graduated from UCLA in 2008. Right in the middle of the financial crisis.
Wow. And we have so many corollaries. I did the same thing. I went to Wall Street, CFA, because I thought I'd be okay. But I had the experience you had in the government. I had it on Wall Street, where I was like, I hate this. I don't want to do this.
Yeah. Yeah. Well, and so, but in the middle of the financial crisis, like we were doing a lot of interviews in banking because that was naturally where you would go if you graduated in finance, in 2008. And, my classmates' offers were just getting rescinded. Like we had a lot of classmates that were getting offers from Lehman and Bear Stearns. Like these are names that you don't even know anymore because like they quickly folded right after that. Luckily, I got an offer from RBC in San Francisco, and it was just such a good fit. The people were a good fit, and it's a Canadian bank. And so during the financial crisis, the Canadian banking system was very stable. And me and all of my incoming class, we just
Went to
flourished.
Toronto, or where is that? Toronto?
So their headquarters are in Toronto. And
Yeah.
so I had to go up there for several months for training. But then we were based out of San Francisco. So
What was it about the Canadian banking system? Were they just not as leveraged as the other countries? They had better regulations, or?
I think that was part of it. I think that they had a lot more cushion that they could fall back
Mm,
on,
mm,
but also the culture it's a bit more conservative, and they are much more reticent to fire people or lay them off or give them.
mm.
And so they just kind of held firm for 2 years, and then things started turning around. But they did fairly well. I mean, I think RBC actually expanded during this time, right?
Oh,
Kind
I
of like
bet. Yeah. Now you
Morgan
could buy all these assets, for pennies
at
on the
these high
dollar, and yeah.
prices. Yeah. So at RBC, I was focused mostly on tech banking. And so that's really what pushed me into kind of the tech world, working with a lot of venture capitalists, working with a lot of private equity funds. And, we kind of did everything from mergers, IPOs, we underwrote debt and leverage. And I just loved it. I just loved it. And being on the forefront of innovation in tech, because I had a lot of colleagues that were doing healthcare or they were doing industrials. Like I get to see all of this really cool stuff. And I just loved the category. Um,
Hmm.
and so I was there between RBC and JP Morgan. I think it was like 5 or 6 years. So I met my husband in business school, and we had been dating long distance for about 4 years. Not dating, I mean, we were married, and it had been
Oh,
four
wow.
years of like between San Francisco and LA. And we're like, okay, we got to figure out where we're going to go. And he's from Cincinnati. And so we decided to move to Cincinnati. Um, and so yeah, so in Cincinnati, there's not a lot of banking. It's much more coastal as far as an
Hmm.
industry is concerned. There is a lot of finance, but it's mostly insurance, annuities, a much more templated finance. And so, I started working with this firm, Centrifuge, that was just getting started. I was the second employee, and it was fascinating because like P&G was the biggest backer. And just for the audience, do you want me to provide a little bit of background on Centrifuge? So Centrifuge was created by Fortune 500s based in Cincinnati and the Cincinnati region, which are notable companies like Procter and Gamble, Kroger, Great American Financial, Western Southern. In Greater Ohio, you have Smuckers, you have a whole bunch of different very notable corporations. And these corporations got together and they said, hey, we're flyover country
Right.
and we don't get access to innovation, and we need to do something about that, not just for us to stay competitive, but also for us to be headquartered in competitive markets for
Right.
talent, right? And so they funded Centrifuge. It was about a $56 million fund one. And the strategy was very focused on early stage venture, seed, Series A. And the
With a
focus.
regional focus, it sounds like trying to back companies and incubate companies in the Midwest, in the Ohio specifically.
Yeah, so there were three goals. The first was regional. So, really stimulating the innovation economy in the Cincinnati and Greater Ohio region through startup funding, and infusion of venture capital dollars. The second was performance based. So, making sure our investments were performing at or better than market standards. And then the third was the corporate innovation aspect, right? So, for instance, like P&G ended up buying Billy, and we were investors in Billy through, I think it was Graycroft or Lear. But those were the three standards put on the fund strategy. And to do that, we invested only in managers. We had about 5% of the fund that we could allocate to direct, but we invested in managers. But when we were looking at those managers, a lot of our consideration was around how strong are they at building companies. Right? They're venture investors, they're not CEOs, but are they very seasoned and savvy to help these early seeds get to scale? It worked really well. We invested across biotech and tech. We were 2 funds in by the time I rolled out to start Vault, but the flywheel had already started in earnest.
Wow. So you had already had this experience of being at a fund of funds. I didn't know it was actually a fund of funds, 95% of it anyway. What was that conversation like with the LPs of these kind of generalist big funds, because you're saying, hey, I'm going to invest in your fund, but I want you to also invest in the Midwest if I back you guys?
Yeah. So our main conversation was this group, just like Ignite, right? This group is better at building than we have access to in this region locally, right? So, for instance, Graycroft invested in everything but the house locally, right? And because of that, they were able to help guide the ship around everything but the house. Ended up not being a good outcome. But things like that, where we could bring in very sophisticated capital to help grow local seeds, was the argument that the LPs were very interested in. And the LPs, of course, were interested in seeing those seeds grow because it brings in talent to the region. And it also, like, for instance, when P&G buys a company like Billy, or for instance, Kroger pilots like a Made Fresh type company, they bring those teams to the region, right, to do the work. And so that's really what they were interested in. We want access to high quality portfolios. We want access to high quality companies, and we want access to high quality funders. And if we can get access to those elements, then we can start to build a stronger innovation flywheel locally through both pilots and acquisitions.
Yeah, that makes sense. And then, so you're in deploying capital into the second fund, and at some point you decide, hey, I want to roll out and do my own thing.
So we were deploying capital. Even in the first fund, we started investing in these entities that basically are creating a portfolio of companies. So rather than a founder creating one company every 5 years, they want to create 5 companies a year, call it. And so the OGs in this category really started in biotech. And so you have companies like Flagship or Atlas or Third Rock, where they're basically taking IP out of research institutions and building scientific talent around it, funding, and doing killer experiments to try to test and kill it. And then if they can't test and kill it, then they grow and scale it, exit to pharma, right? It's a very structured process.
Yeah.
They're doing it from inception, and they're doing it across a portfolio, right? So we started investing in what we call company creators back in 2014. And through Fund 1 and Fund 2, we invested in about 5 unique entities that were doing this build work across both biotech and tech. And the performance of the model itself was just so head and shoulders above what we were seeing from traditional venture. When we looked across the market in this category, we're like, nobody else is investing systematically here. However, it's highly dispersed, right? It's very decentralized. Why is it that nobody's focused here? And I think there's a lot of reasons for that, but we just saw a big gap in the market to produce alpha. And so we started talking to our LPs. We started talking to the rest of the team at Centrifuge, like, hey, we really want to do this. We think that there's an opportunity here. And we were going from, at Centrifuge, we were going from Fund 2 to Fund 3. And it just made sense for the timing because the strategy was kind of shifting a bit to more direct. And so we spun out, my partner and I, and we created Vault. And Vault was launched in 2021. First close was 2022. And we've invested.
You got in right before the markets kind of went sideways.
Like our first close was in 22. So we lived through most of the turmoil. But we've invested in 7 builders to date across biotech, tech, and deep tech. So things like materials and sensors. And it's been a really interesting experience. It's an incredible category. I think it's very nascent. So it's changing faster than even we can catch up with it. But that's also what leads to the opportunities.
Yeah, that's amazing. Tell us about, I want to get into the Vault Fund and kind of this build motion specifically. I think it's really interesting. But back to Centrifuge really quick before we move on, is why did they start changing their thesis in Fund 3?
So Centrifuge is owned by a parent company, which is a nonprofit entity. And that entity has several CEOs that kind of changed hands over the years. Once you're in a fund, you're in a fund for 10 years. There's no changing that strategy. You are married to, and that's what it is. But in between funds, you can always tweak and change your strategy. And so, we had a change of the guard at the parent co, and they were much more interested in starting to invest more directly. into startups that were regionally based. I think maybe it's the right decision for them as an organization, but it's a completely different skill set, as you know. Like what you do and what I do are completely different. You have to be really strong technically, you have to have really deep industry insights, and you have to know founder talent, right?
Yep.
For me, I basically have to know talent,
That's really
right?
interesting, right? Because you're backing managers, and then so
Exactly.
you have to really assess the manager. It's a
Because
different,
also
yeah.
we're looking at multiple portfolios, and oftentimes venture firms tend to be more generalist. Like even if you're an AI manager, right? You're still a generalist across multiple categories. You might be doing AI in fintech. You might be doing AI in prop tech. You might be doing AI in health tech, right? So for us, we really have to be able to assess where a manager has strengths and where a manager has weaknesses and how those two are going to combine to create a stellar portfolio.
Mm,
Whereas you, the manager, like you really have to get your hands dirty every day with those companies, right? And you
mm.
have to help your founders, you have to get into the weeds. We tend to be like one step removed from that and really focusing on teams, the management teams, the talent, if they're focused on LP as a priority. You'd be surprised. I categorize, and I'm going to get off topic, but I categorize the venture universe in two buckets. One is the glamourati, right? And I'm
Yeah.
sure you know some of them.
Yeah. The Ashton Kutchers, the NBA stars. Yeah.
Right. Well, but they're flying on G5s to go play at Pebble Beach, right? That's
Right.
the
Yeah.
glamour.
Yeah.
And
Yeah.
then you have the hustlers that are like everywhere all the time. They're at every single conference you go to, they're at all the annual meetings, they're like
Mm.
meeting, greeting, shaking hands. I don't even know how they have time to sleep. But like from
I
my
fall into a different bucket. I'm neither of those, but I'm
okay,
a hustler. Yeah. Because I don't like to go to events. I like, I
well,
like to
what's your
just,
hustle? What's your hustle look like?
no, I work many hours, many days a week. But I think it's, it's doing things like this, doing the pod, investing in lots of companies, helping them. But I prefer to control who I meet, and I can't do that at events, you know?
Yeah, and maybe events is like
Yeah.
the
Yeah.
wrong association, but it's basically investors that are just working their tails
They're
off.
just working hard. Yeah.
Right?
Yeah.
They're not doing like, Four Seasons and G5s and houses in France,
Yeah.
right? They have their heads down, they're working hard, and they're putting points on the board. From our experience, there is a very wide dispersion in the performance of those two categories, right?
That's interesting. So as you're looking at managers, you're kind of trying to put them into one of those two buckets. Are they a hustler? And then if they are, then let's dig in. So I'm guessing you like to invest in hustlers then.
Yeah, the performance is much
Yeah.
better. Yeah,
Yeah.
and when you look across the venture studio land, they're hustlers
Right.
because the founders
They're
that
building companies.
yeah, they're building
Yeah.
companies, which is hard. It's the
Yeah.
hardest stage of a startup's journey is from
Zero
0
to one.
to 1. Yeah,
Yeah. Yeah. Going 0 to 1. We have some IP here. We have a unique take on the market. We think there's a gap.
yeah,
Let's incubate this thing,
yeah,
build some technology, build a team around it, and try to get it going. That's
yeah,
hard. That's like being a founder, basically.
yeah, and imagine doing it across 5 companies.
Yeah, or some of these venture studios are kicking out 10 or 15 a year, right?
Yeah,
Depending on the size of the team, you know?
we should talk about that. Like, it really this is not a scalable category.
Mm,
We've seen some high volume strategies, and they don't work.
mm.
It's such hand-to-hand combat.
Not with venture studio models. Yeah, I would
It
guess.
has to be concentrated, it has to be high quality. Otherwise, you end up like one of the biggest advantages in venture studios is the early ideation, testing, and discovery work, right? So these venture studios they tend to be wanting to kill as fast as possible, which you want. You should
Mm,
not be investing a ton of money and losing it. So usually we see this early like testing phase 10 to 50,000, right? Or
mm,
below, let's call it below 100. But you want to be able to write companies off, at least take the technical risk off the table as much as possible so that all you're dealing with is like execution risk and market risk, right? When we see high volume strategies, they're not taking that technical risk off the table because they're just trying to put a lot of stuff out there.
mm.
and see what sticks. And it just doesn't work out well. Is a long journey. You're
Yeah.
looking at a 10-year plus journey with these startup studios.
Right.
You really have to build sustainable companies that are solving acute challenges, right?
Yeah. But you also said there's a lot of dispersion around the model. Maybe you could dig into that a little bit.
Yeah, and I think one of the common denominators for the dispersion is that there's just not a lot of barriers to entry to starting a studio. Like if you think about how much capital you would need to raise, the average check size for a launch of a company is about 250 to 500,000, right? So if you want a portfolio of say 10 companies over a 3-year period, you raise 2.5 million and there you go. It's just
Your
not,
your studio.
it's your
Congratulations.
studio. So it's not,
Bunch of small checks, you can get it done.
yeah. And so one of the things that creates is it just creates this very long tail of studios that yet to have built a sustainable platform, right? So they're just emerging. They might be on their first studio. They just don't have a lot of traction yet, which is fine. I think we're going to see a ton of talent come out of that long tail. But it creates this very wide dispersion in the numbers. There's no banding. So for instance, we've talked to over about 350 now, and we have data on almost all of them. And we see like IRR spreads between like a negative 14% all the way up to like a 311%, right? And so
TVPI, right? Because there's not a lot of DPI. These things take 10 years.
yeah. It's a TVPI based IRR most of the time. There are some models we're starting to see that have remarkable DPI, which I think in this market is just going to be incredibly advantaged. But that is a TVPI driven IRR for the most part.
Yeah. That makes sense.
Yeah.
And for the audience, TVPI is total value to paid in capital. It's kind of a forward-looking metric of what the underlying value is of the underlying portfolio.
Yeah, which if you think about where these builders are coming in, they're coming in at almost a zero cost basis, depending on the structure, right?
Right.
So when
and
you
they're
start,
getting a huge chunk of these startups, right? I mean, they're placing the executive team, and how much equity are they giving the founders, these
so we should talk about
co-founders?
that. Yeah, because I think that's a big market. It's a big market misnomer that some studios do, but I can tell you the studios we see that are taking north of 30%, they are typically a first time studio. So the benchmarks around ownership are quite banded around higher performing studios. And it tends to be about 30% to the studio, 30% to the CEO founder, and 30% to outside capital. And this is post seed, right? So everybody would get
when they raise that big first million or 2 million in the seed round. That's kind of what the cap table should look like, is a third each.
It depends on the process too. So it is kind of Wild Westy in studio land. Like some studios will do co-builds. So they'll find talent and they'll build directly with that talent from day zero.
Right.
Some studios will build and then they'll go find the talent at a certain stage. And we found that the later that stage where they find talent to come in, the more ownership the studio takes, the less the founder takes, right? So, and I think there are like biotech land where you very regularly, because it's scientific talent and not necessarily business talent, you very regularly see 70 to 90% ownership around seed. And I think that that's very, very common also in deep tech where you're dealing with scientific talent and not business talent or tech talent. It's just a very different dynamic. But I will say that the banding around ownership has really come into focus since we started investing here. Like when we were investing, we were seeing studios all across the map. And what we found is there's a negative correlation between ownership and performance. So the more ownership the studio takes, the worse the performance. And I think that's very much driven by their ability to recruit talent. So it makes much more sense to have less ownership and a much bigger pie than more ownership in a tiny little pie.
And what's a good rule of thumb as you place that founding team? How much ownership should they have to incentivize them? And at what point is it just there's just not enough incentive on that cap table for them to work hard?
Yeah. So there was a big blow up in New York with a studio called Fractal. There were several there were several articles written about their process and their structure. But just as an example, I think that they were giving their founders like 12% ownership.
Oh, wow.
Yeah. And so the problem with that is, when you go out for external funding, no seed or Series A investor wants to see a founder that's getting 12%
No, I
ownership.
just passed on one where they had, I think they're on their third seed and they had 40% between the two founders. I was like, I feel like that's too low.
Too low.
At a seed extension where they were, I was like, they're going to
And
go A and then B and then C. And if they're successful, they're
yeah,
going to end up with like 5% of the company each.
5%. Yeah. Yeah. It's a tough slog. Like, but it's because of exactly that, right? The founders don't have the incentive to put up with the pain that is
Yeah.
involved in getting to scale. And so it is very
Yeah, they
much,
turn into employees instead of owners. Instead of working 60, 80-hour weeks, doing whatever it takes, they kind of start behaving like a 9-to-5 job.
yeah. And so, but we've seen founders like Susie Orman has come into one of the fintech companies that's being created. Keith Raboy is CEO at a company that's being created out of Atomic. There's significant talent coming
Wow.
into the category, but it's all a negotiation.
Yeah.
And one of the things that seasoned builders have learned is it is very much worth just giving them more ownership, having them have more accountability to the company, and building a bigger company. The studios that know what they're doing, they don't mind taking a back seat at the right time.
Right. That's really interesting. What excites you most about investing in these kind of builder funds, venture studios compared to direct?
Yeah, it's a really good question. So one of the things, and we were talking about this before the podcast started, but I've been investing in venture as an LP for the past 12, I think going on 13 years now. And in early stage venture, one of the things that we were plagued by is the performance is incredibly inconsistent. So you may invest in the same seed manager, and their fund 2, it may be a 5 multiple fund. Their fund 3 may be a 1.5 multiple fund.
Wow.
You're just in this like seesaw type of environment. And not even to say like generally like the inconsistency between seed managers, right? When we
Just
started
fund to fund. What do you think that is? Because usually if you're going from fund 2 to fund 3, you're probably tripling in size. So now your check size is different, how you behave is different,
yeah,
and so the game is actually different.
yeah,
Um,
yeah, but it's also harder to return that much money.
hmm,
And
yeah,
do you care as much about your LPs when you're making $500,000 to $1 million a year?
on fees. Yeah.
Right? Like that's my point about glamourati versus hustlers. I think there's also a lot, like there's been a lot of studies on fund 1 versus fund 2 versus fund 3. There is a natural dip
Hmm.
for manager performance.
As you get bigger and because you're instead of writing little 100K checks, 50K checks, and now you're writing $1 million checks, and it's just a different game.
It's a different game.
Yeah.
And but when we started looking at the studio category, so there is this wide dispersion, right, in performance. But from an institutional investor standpoint, it's very easy to spot, right? There are probably 3 common denominators that really make the studio model tick. And when you see it working, it really should be like a wash, rinse, repeat cycle, right? These builders, they have so much industry insight. They know exactly kind of what the leading indicators need to be at what point in time, and they are ruthless about killing. And so I find the category to be able to have, it has the potential to produce so much more alpha than what you see out of traditional venture. Like I think one of the others, so there's a whole bunch of reasons, and I would say most of them relate to the performance of the category.
Let's dive into those 3 things. One you said is they can spot the leading indicators, or is that one of the 3 things?
So what we look for, what we spend the most time on is talent, right? So they have to have experience with build, scale, and exit. The talent is, it's not just the talent of the partners that are running the studio, but it's the talent of the founders they're bringing in to run their companies, right? And we spend a lot of time there. If you look at like the news articles again on like a fractal, you'll see the talent can make or break your studio. You just can't you can't compromise your ability to recruit in very seasoned operators. The second is process. And so and we look at it as ball control. So our threshold for whether you're a studio or not a studio, company creator, because a lot of people use that term studio and they're not, is whether you have ball control over the build process, right? So otherwise you can be an accelerator, you can be an incubator, you can be a pre-seed fund, but you're not a company creator. So the ball control is what generates the efficiency and the repeatability of the model. Without that, it starts to look a lot more like traditional venture. Higher loss ratios, companies that scale and then the valuations decrease significantly, et cetera. So we look a lot at their process. Is their process proven? Do they know what the leading indicators need to be? Do they know what the milestones should be? Like, how are they thinking about putting these companies through a rigorous process where it's not just like, I really like this technology, and so I'm going to put money into it. No, if it doesn't have the data around it, if it doesn't have the organic uptake in the market, like, no. So that's the second one. And then the third one really is structure. And I know we kind of started talking about this, but structure is really important in the studio world. And we're still very much just learning about this. But structures, so there's several. There's your 2 and 20 fund, there's your holding company, and then there's what we call a dual entity. We will only invest in entities that have inception level exposure, meaning that if it's a dual entity and it has, let's say, a holdco and then a fund that may own the holdco, it's just not going to work for us because you're so diluted by your capital exposure being beyond inception stage that it doesn't create the alpha that we're looking for.
That's interesting. So in traditional venture, you have a limited partnership that invests directly into the cap tables of startups. How is this dual entity structure different in this model, in the venture studio model?
So the dual entity usually is like a holding company that's doing the actual build work, right?
Okay.
And then a fund that has some type of relationship to that holdco. So in some cases, they both have separate funding mechanisms. And in that case, we can entertain it. But in some cases, the fund actually takes, like, let's say you raise 50 million, and then you're going to take 5 million. So you're going to take 10% of your fund, and you're going to fund a holding company structure for 5 million. That's then going to create 10 companies from scratch, right? And then you own that holding company. So
The fund does, yeah.
they'll build 10 companies. Like,
Right.
you own whatever percentage, let's call it 90% of holdco. So then those flow back up through the fund. And then, the fund either funds it for preferred or, you get external funding. But the rest of the 45 million that you have raised, that you haven't invested into the studio, that gets invested beyond inception stage.
So you want to invest in that top entity, right? So you have exposure to all the underlying holdcos.
Oh yeah, I see what you're saying. Okay, yeah.
Yeah.
So the portcos under the holdcos,
Yeah.
we want exposure to holdco that's
Right.
building portcos, right?
Yeah.
But we anticipate that holdco would naturally have common and preferred through into its portcos, right? Sweat equity, and then for the invested capital that they're providing.
Right.
So yeah, so in that case, we would want access to holdco.
Is that how they usually break it down? If you're a venture studio, you raise 50 million, you have kind of the limited partnership that all the LPs put the money into. And then there's like a holdco below that has interest in all the different companies. So it's like this. Okay. What is it?
I mean, I would say of the structures we do see a lot of 2 and 20 funds because that's what LPs accept. Holdcos are a little bit tougher, but honestly, holdcos are hugely advantaged against funds, opinion of us.
Yeah.
But
Why
we've
is
been
that?
doing this for a long time. So holdcos participate in equity starting from inception. The challenge with the 2 and 20 fund is they're using that 2% management fee to fund their discovery, ideation, and validation work. They don't get ownership until they write that launch check, in which case they get preferred equity, right? So holdcos start from inception. They get sweat plus preferred because they're providing investable capital, and they can kind of grow on a non-fee basis. Now it's an implied fee, but that fee is creating equity value. And that's the biggest difference. You don't have to basically dip down before you can start generating positive value. And there's several others. Like for instance, we just invested, you don't have to raise 50 million in a holdco
Right.
because you're not using fees to fund your OpEx. You're using your raise to fund your OpEx. Like we just invested in a $5 million holdco that's performing brilliantly. Their strategy is very strong. But if you can do a studio with a $5 million holdco, because that 5 million is basically funding you for 3 years, right?
Yeah. That's really interesting. An interesting structure. I had no idea that's how it worked. So, as a pre-seed investor, as I evaluate these startups coming out of these, not incubators, but these builders, how should I think about investing in these?
In the builders or in the companies that they're
The,
building?
the companies themselves.
The companies that they're building.
Yeah.
So one of the things that we've seen, the success rate on these studios tends to be very high because of the early ideation and validation that these companies have to go through to get out of the gauntlet and get launched. That in and of itself creates a higher success metric for downstream capital. But that's one of the things that I would look at is, has the studio had strong successes? And then the ownership of the founder is also very important and something that you should spend time with. And then just like you would with any other company, right? Like, are they solving an acute and sustainable problem, right? If it's a candy subscription app, like, no, thank you. But if it's solving like a really big like mental health challenge or something like that, then it's much more interesting.
Yeah.
So I think it's
So
definitely.
in short, just the way I would evaluate any other company, but one thing to look out for is what we discussed, which is that ownership percentage of the founders.
The cap table.
Yeah.
And
At what
also,
point is it kind of like a should I pass coming out? So let's imagine they're post-launch, post-revenue. They're raising their first, kind of VC round. It's a pre-seed or seed, whatever you want to call it.
yeah,
They have 20 or 30K of monthly recurring revenue. So it's kind of it's a business now. And I'm looking at it and I'm looking to invest at 5 or 10 cap, whatever it is. But I look at the cap table.
I see.
And, at what point is it like, oof, you should probably pass? It's the fractal 12% versus the 30 or 40%. Like, what am I looking for there? And any other red flags I should consider?
So I think you want to make sure that the founder is all in, right? If it's 30 or 40% ownership by the founder, but it's going to be it's efficient to scale from a capital standpoint, like that's a consideration. If it's going to be like in deep tech where we see a lot of capital infusion
Right.
before they can get commercial, then it's a different consideration. The other thing that I would look at is the time. So these models tend to be much more time efficient, and that's because of the process. But if you see something that's taken 2 years to get out of a studio, I would be careful about that because it means like their upfront process maybe isn't up to. Yeah, you should really look for companies that you're investing in seed or A?
Pre-seed and seed.
Yeah, so you really want companies that have been launched within the year that they're raising. It really shouldn't take longer than that to get to pre-seed or seed.
So as you go out and you raise money, because you're raising money for your fund, just like all of us, everyone else, I guess. How do you communicate this to your LPs as you kind of reach out to the family offices, institutionals? How do you position your fund against other funds?
It's performance based. I mean, we're all in the same industry. We are not mission based. We are extremely alpha consideration. And the historical track records, both for us and for our managers, they're really good. And so I think one of our Achilles heels is even with that alpha, there's a lot of education that has to happen because LPs see the performance. The performance is a step change from what you see in traditional venture benchmarks. And it's like, wait, but why? And why am I just seeing this from you now? Like, why is this not more well known in the market? And there's real reasons, but it just takes a lot of time to kind of, okay, well, here's why we're seeing this performance. Here are the economics around the model, but it's very alpha focused. We tend not to speak well to investors that are used to traditional, like real estate, right? So if they're real estate or Publix or something that's completely unrelated, this is just not going to hit home. But if they're already doing venture and they get venture and they understand these private asset markets, that's when they get it more readily.
And what is that step change as you communicate to them when they're looking at it? They're like, It's not X, it's Y. What is that difference?
So traditional venture usually is thought of having a top quartile around 25% net
Hmm.
IRR. Ours, we see top quartile about 53%
Oh,
net
wow.
IRR. But IRR also, you kind of have to break down, right? Because it deals with money in and money out and it's time bound. So
And the timing. Yeah.
because of the efficiencies around capital, you tend to see, but we even have some studios that are 10, 12 years old that are still in the 50% net range.
Yeah.
They've
Do you
come
think,
down from 100, but
yeah.
they're still good.
Do you think it kind of gets competed away over time, like other asset classes where there's more money that flows in and then it's harder and harder to find that alpha? Is it kind of like, you know how like marketing ruins everything? You know, it
Yeah,
kind of goes
I
and
hope.
saturates a channel.
And the only reason I say I hope is because as we go through that, the market defines the category's best practices.
Mm,
And so, like right now, it's super Wild West because we're one of the only investors investing systematically in this category. But over time, if it were to become hyper competitive and they compete out each other,
right.
that means that there's more capital going into this category to support these builders. And so, if that's the case, you just have you have a more matured category. And
Yeah.
that is my hope. You would still have top performers always that are able to recruit in the best talent. But I don't think we're there yet. I don't think we're
Yeah.
there for a few more years.
And then when you're communicating to your LPs, is it also a kind of a 10-year fund? It's like, hey, we're going to go invest and
Mhm.
these are going to take a while.
Yeah, even
Yeah.
shorter now because we're very focused on holding companies. The markets have been very focused on distributions because we've been in a liquidity crunch, right?
Right.
Company creators have the ability to sell secondary much earlier than traditional investors because they own common, because they're founders. And if they have a strong performing company, they can easily sell some common in downstream rounds. We've seen this even more so in the holding company space, where holding companies are able to sell secondary much faster than traditional venture and therefore create distributions. And one of the things that we've seen, I don't know if there's any data on this, but venture funds, they tend to peak. Like you saw this big peaking of performance in like 2020 and 2021,
Right.
but there was very little distribution in those time periods, right? A lot of investors held. And then now you start to see like a couple turns in value of decline. And so one of the things that we talk to our managers about a lot is focusing on like time bound exit periods, like knowing when they go into a company, they want to take 20% off the table in the Series B, right? Around certain parameters.
Hmm.
Because we've never talked to a manager who's sold secondary who's like, oh man, I really regret selling that secondary.
Really? That's an interesting point. And it's something
Insurrect-
I've wrestled with as a lot of my companies. I've been investing for other people's
insur-
money now like 5 years. And so we're starting to get into those series Bs and Cs. And I'm thinking, how much money do I take off the table for my LPs here?
20% is like the normal that we see. But and I
Per
want to
round?
no, like 20% off the table, distributing that to LPs and then holding. Um,
Okay. At series B.
Yeah, around Series B, Series C,
Okay.
depending on the trajectory of the company. But yeah, but your point is right.
Because
Like they're
yeah.
like we've seen managers that by necessity they have to sell secondary like in between rounds and deleterious. That's
This is a really interesting point that I want to really dive into. And I know we're short on time, but you think about a Series B valuation. What are you seeing? Series A, I'm seeing 80 to 120. Series B is probably 2 to 250 ish. And so if I'm getting in at 5 and 10 caps, I'm probably sitting on a 20x at a Series B with some dilution, whatever. But let's just, for simple math, let's say it's a 20x and I sell 20% of that. I've locked in a 4x DPI on
exactly.
that deal. What if I had, asking for a friend, an opportunity fund? Would I be able to invest and buy the earlier funds shares into the opportunity fund
Yeah, we see this
if
a
I
lot.
was, yeah,
Yeah, and we're seeing it more now. I think you just have to be careful. Like there definitely has to be third party valuations. You have to make
yeah,
sure you're auditing everything because if one fund ends up doing really well and the other fund doesn't, you're going to get sued. So you
yeah.
just have to really be careful around conflicts, but we do
Mm.
see basically transitioning private assets from one fund to another.
Yeah, I think I'd be really careful in that situation, probably get legal advice. But it's an interesting thing. So you're actually advising your GPs in this case. at these venture studios to take about 20% in the Series B and return that DPI.
Yeah, yeah. Depending on like if the company's doing well, they have oversubscribed rounds. Like you don't need to sell secondary if the company is struggling and you can't raise your round, obviously.
Mm-hmm.
But if everything's going according to plan, just take 20% off the table, distribute it out to LPs, and then you're kind of sitting pretty because if you do end up losing value later in that company's life, you've still already made money for your LPs.
Yeah, you've locked it in. And locking in a 4 or 5x DPI per deal, if you can do that consistently, can really juice those returns and really protect your down. It's almost like insurance.
Yeah. Well, and I think too, one of the things that early stage managers don't think about enough is over time they lose influence over the company,
Right.
right?
Oh yeah.
And
You start
so
getting these waivers in your email,
well,
like, hey, can you sign this waiver?
I mean, it's
Waive your rights in this. And you're like, why would I waive my rights?
you can be forced into these really bad situations
Mm,
that you can't do anything about. You're basically taking some of your risk off the table. And
right.
I think that in most cases, it's a really smart thing to do. But honestly, less than 1% of managers do it.
That's interesting. I'll definitely take that advice to heart. Really enjoy the conversation. I could talk to you for another hour on this. Where can folks find you online?
Yeah, so on LinkedIn, I can probably send it to you. It's on I'm not really on X that much.
I'll link it in the show notes as well. Yeah.
But vaultfund.com is our website and they can always reach out to us there. Find me on LinkedIn. I'm pretty easy and active on LinkedIn. But yeah, that's probably the best place.
Well, thank you so much, Sarah. Really enjoyed it.
Yeah, thanks, Brian. Great to talk to you.
Yep.